For decades, there was a single rule that every government, every central bank, and every financial institution treated as sacred. They didn't debate it. They didn't question it. They built entire systems around it. And for a long time, it worked. Until one day, it didn't. Not with a crash, not with an announcement, but with silence. Because when this rule failed, the system didn't collapse immediately. It adapted, quietly, and most people never realized the rules had changed at all. Financial systems don't run on laws alone. They run on beliefs. Not beliefs in the emotional sense, but shared assumptions so deeply accepted that no one thinks to challenge them. Assumptions like markets will self-correct, debt has limits, risk is temporary, stability is safety. But above all, there was one core rule that shaped the modern financial world more than any other. Pain must be immediate. Losses had to be recognized. Bad decisions had to be punished. Excess had to be cleared. Recessions were not failures, they were resets. This wasn't cruelty, it was discipline. And discipline, the system believed, was what kept everything alive, until the day discipline became too dangerous to allow. The old rule, pain clears the system. For most of modern financial history, downturns were not avoided. They were endured. Banks failed. Companies collapsed. Markets fell. And while that pain was brutal, it served a purpose. It removed excess. It punished leverage. It reset expectations. The logic was simple. If mistakes aren't allowed to fail, they multiply. This belief shaped everything. How interest rates were set, how debt was managed, how markets priced risk. When something broke, it was supposed to break fully, not halfway. Short-term suffering prevented long-term decay. At least that was the theory. And for a long time, it worked well enough to become unquestioned truth. Why the rule was trusted. The rule didn't survive because it was moral. It survived because it was functional. Every time pain was delayed, the consequences grew larger later. History reinforced this lesson again and again. Asset bubbles burst harder when protected, debt crises deepened when postponed, inflation accelerated when denied. So policymakers internalized a simple fear. If we interfere too much, we make it worse. Markets needed fear. Investors needed consequences. Systems needed failure. This wasn't ideology. It was survival logic. And that logic held until the system itself became too large to absorb the pain. The moment the rule became dangerous, the world didn't change overnight. It scaled. As economies grew more interconnected, the cost of failure stopped being isolated. One bank failing no longer meant one bank failing. It meant contagion. One market crash no longer meant a reset. It meant global paralysis. The system didn't become fragile because people were reckless. It became fragile because it was efficient, highly leveraged, tightly connected, optimized for growth, not shock. And that's when the rule, pain must be immediate, stopped being stabilizing, and started becoming existential. The first exceptions. At first, the rule wasn't abandoned, it was bent. Emergency liquidity here, temporary backstops there, just enough intervention to restore confidence. Each intervention was framed as one-time, temporary, exceptional. The language mattered. Nothing fundamental had changed. This was just crisis management, but every exception weakened the rule slightly. And once a system learns that pain can be delayed, it never forgets. The shift. No one voted for. Here's the part most people miss. The rule didn't fail because it was wrong. It failed because enforcing it became politically impossible. Modern societies don't tolerate visible pain. Well, market crashes become political crises, bank failures become voter, anger, recessions become leadership failures. The system realized something dangerous. Immediate pain threatens legitimacy. So instead of allowing sharp resets, policymakers chose smoother decay. Losses were still there, but they were hidden. Pain was still paid, but slowly, failure still existed, but quietly redistributed. The rule didn't disappear. It inverted. The new unwritten rule. The new rule was never announced. It never appeared in law books, but it governs everything today. Never allow visible failure if it threatens stability. That meant losses pushed into the future, debt extended instead of resolved, risk socialized instead of punished. The system stopped asking, is this healthy? And started asking, can we survive this quarter? Stability replaced correction. Calm replaced truth. And for a while, it looked like success. Why it felt like a solution. Markets recovered faster. Crashes became shorter. Asset prices stabilized. From the outside, it looked like progress. But under the surface, something subtle changed. Risk no longer disappeared. It accumulated. Debt no longer cleared. It rolled forward. Mistakes were no longer punished. They were absorbed. The system didn't heal. It anesthetized itself. And anesthesia works until it doesn't. did us tears the cost that wasn't T immediate here as the trade that was made, short-term stability in exchange for long-term distortion. No one announced it, no one explained it, no one voted on it. But everyone living inside the system began paying for it anyway, not through collapse, not through panic, but through erosion. And that erosion is invisible unless you know what to look for. Where we pause. By the time people noticed something felt wrong, prices no longer made sense, savings didn't feel safe, growth felt hollow, the rule had already been gone for years. Where the pain went, when the old rule died, pain didn't disappear. It was reassigned, because in a closed system, losses never vanish. They move. If banks didn't fail, someone else had to absorb the cost. If markets didn't crash, someone else had to pay the bill. If governments refused collapse, someone else had to surrender stability. That someone wasn't loud, it wasn't visible, and it wasn't organized. It was savers. The invisible transfer once immediate failure became unacceptable. Policymakers needed a mechanism that could reduce real debt, stabilize institutions, avoid public panic, operate quietly. They found it, not through defaults, not through taxation, but through time. Time combined with inflation became the new clearing mechanism. Debt stayed nominally intact. Balances remained paid. Contracts weren't broken. But purchasing power was. This wasn't theft in the legal sense. It was dilution. And dilution doesn't trigger protests. Why savers never saw it coming. Most people were taught that inflation was accidental. A side effect, a mistake, a temporary imbalance. But in the new system, inflation wasn't a bug. It was a feature. A slow, socially acceptable way to erase obligations without admitting failure. Every year, prices rose. Real debt shrank. Governments gained breathing room. Institutions survived, and every year savers lost something they couldn't easily measure. Not money, time. The moral shift. Here's where the system crossed a line. Under the old rule, prudence was rewarded. Excess was punished. Under the new rule, prudence became a liability. Leverage became survivable. Saving cash stopped being safe. Avoiding risk stopped being rewarded. Doing nothing became the worst decision possible. And the system didn't say this out loud, but incentives spoke clearly. Why no one reversed it? Once the new rule took hold, reversing it became impossible, because undoing it would require higher interest rates, real defaults, visible failures, public anger, and that anger would fall on those in charge. So instead, the system doubled down. More delay, more liquidity, more stabilization. Every intervention made the next one necessary. The system wasn't steering anymore, it was balancing, and desperately. The stability, illusion. This is why modern crises feel different. They don't arrive with explosions. They arrive with exhaustion. Markets don't crash or they stall. Growth doesn't die. It decays. Confidence doesn't break. It thins. Nothing looks broken enough to fix. And that's the genius and danger of the quiet deal. Who benefited? This wasn't accidental either. Those closest to the system benefited first. Large institutions, asset holders, debtors, those farthest from leverage paid the price. Savers, wage earners, fixed income households. The system didn't want collapse inequality. It refined it, quietly. Why this wasn't a conspiracy, this matters. No secret meeting decided this. No single villain planned it. It emerged from incentives. When faced with collapse or delay, every system chooses delay. When faced with visible pain or invisible erosion, it chooses erosion, not because it's evil, because it's human. The final lock-in. Once inflation became the release valve, there was no going back. Raising rates too high risks collapse. Allowing deflation exposes debt. Admitting the truth undermines trust. So the system stays trapped. Managing expectations. Controlling narratives. Extending timelines. This isn't T, a temporary phase. It's the new equilibrium. What this means going forward. The old rule is gone. Pain is no longer immediate. Failure is no longer visible. Correction is no longer allowed. What remains is management, not of growth, not of prosperity, but of perception. Final realization. The system didn't save everyone. It saved itself, and it did so by trading. Sharp truth for slow erosion. Collapse for permanence, honesty for stability. This was the quiet deal, and it's already been paid for, just not all at once. If you want to understand what's happening next, don't watch markets, watch incentives, because systems don't warn you before they change the rules, they just stop explaining them.